Have 3 to 5 minutes? If you run your own business, here's what you need to know about getting a mortgage. Walk into your local bank or credit union, and you'll face the same rigid loan programs that everybody has. They're going to want your tax returns, and when you're self-employed, that's normally the issue. So you're self-employed. The smartest move you can make is maximizing your tax deductions. You hand over your returns, and after the lender sees your adjusted income after all those deductions, it's not going to look pretty. You pull in $300,000 a year, it's fantastic. But you deduct $200,000 a year in write-offs and expenses, so they get to see the bottom line at $100,000, and that's what they're using to base their decision on for your loan. And maybe that works for your purchase. Maybe it doesn't. $100,000 is a ton of money. So maybe it does work. But if you run a business and you carry any kind of overhead or have business loans, credit cards, things you operate on, it all plays into your debt to income ratio. So if that doesn't work, you need a bank statement loan. This program uses your bank statements instead of tax returns. But for the sake of this loan, you don't provide them to me or the lender. No one gets any copies of your tax returns at all. We actually don't even do tax return transcripts on them, so we don't even verify it. These bank statement loans work for your primary residence, a secondary home or a vacation home, or investment properties. So you can use them on any loan type or property type. So here's how we calculate out your income on a bank statement loan. We review 12 months of bank statements and we add up all the deposits over that time period. We then take out, at minimum, a 25% expense factor because not everyone can work straight dollar for dollar profit 100%. So we assume there are expenses and we deduct out 25% from that deposit number. Whatever is left over, we divide that by 12, and that's your usable monthly income. But then people always say, aren't the interest rates higher? Yes, they are. This is a non-traditional loan program, or a non-QM, which stands for non-qualified mortgage. It's basically a portfolio loan. So the rates do run a bit above standard, but not points and points higher. We're not talking thousands of dollars of difference per month in interest. So let me tell you why it really doesn't matter. Let's go back to our original example of the $300,000 a year. You earn $300,000, but you deduct $200,000 in write-offs, so you're left with a bottom line of $100,000. If that's not enough and you go the traditional route where you want to use a conventional loan and have to provide your tax returns, you need to reduce your deductions and your write-offs over the next 2 years to get a 24-month average. Let's say you're looking at $1 million property, and you need to show $200,000 of income instead of the $100,000 you're showing now. So you have to reduce your write-offs by $100,000 a year, meaning the $100,000 that you're not writing off, you're paying taxes on that extra $100,000, and that's a lot. That means on average for business owners in the United States, if you reduce your write-offs by $100,000, so again, you make $300,000, let's say on paper this year, you're showing you make $200,000 because you want to qualify for that. You could be paying anywhere from $40,000 to $60,000 more in taxes to the IRS by reducing the $100,000. So let's dive a little bit deeper and break these numbers down of a bank statement loan versus a conventional loan and what the true cost difference is. A bank statement loan might cost you a half an interest rate point or higher. So let's hypothetical numbers say 6.5 versus 7%. If a conventional loan is 6.5, a bank statement loan might be 7. So there is a difference. On a $1 million home, that's roughly $1,000 a month in interest or $12,000 a year. But I think you can see where I'm going with this. If you qualify, yes, you're spending $1,000 more than a conventional loan, but the trade-off to qualify for that conventional loan, if you don't want to pay the extra interest per month on a bank statement loan, you're going to be giving the IRS $40,000 to $60,000. So the trade-off is pretty simple. It's right in front of you. The bank statement loan, yes, more interest monthly on your house. Would you rather own a home and have that, or write a $40,000 to $60,000 check to the IRS just so you can save $12,000 a year? Interest isn't fun. I understand that. You pay it on credit cards, student loans, vehicle loans, personal loans, business loan, everything. Unless you operate your business entirely in cash, someone somewhere is collecting interest from you. That's just the reality of it. The bottom line here, if you're self-employed, a bank statement loan deserves your attention. My team and I have spent the last 6 years specializing in helping self-employed borrowers around the country get into homes and help them with creative financing when other banks and credit unions say no. We've become one of the top lenders in the United States for these loans. So if you have any questions, please reach out. I'm happy to answer any questions you might have.